Peter Rose, Longwood Currency Trading. It's a early December day, and it's really foggy out, and it's raining and sleeting and all kinds of bad stuff. How do you time your trade entry and get that right? It's an important thing. It's simple, but it's an important issue to keep in mind during your trade entry. But I got to finish up my coffee here. I just got it poured. I'm cold. We need the coffee. Back at you in just a second. Just a little bit crimp. Keep things moving. All right, I got the coffee. Let's have a chat. So I thought I'd take this shot so that we could look out the window here in the kitchen. It's pretty bleak out there. We got stick season. We've got some snow on the ground that's melting, and it's cold. And when this thing freezes over later tonight, it's going to be a real mess. It's we got about a little over 2 inches of snow the other day, and now over the night we probably got another, and that melted and turned into slushy crap. And then overnight we got probably another inch, which is more of a wet, sloshy stuff. So that's just the way things are in New England. It's all about the timing, and it's all about your timing on your trade entry. You know, look, an integral part of your entry analysis in your trading is determining the viability of the trade beyond just that the conditions are right. If you get the timing wrong, there's a strong probability that the price is going to retrace on you and you're going to get stopped out. How many times have you gone into a trade where that's happened? And I say all the time, well, the reason you get stopped out and the reason I'm willing to accept the short stop point that I use is because I'm trying to hone my skills to improve my trade entry process. And the reflection of a good trade entry process is a good win-to-loss ratio, because if you can get your trade to move in the right direction so that you don't get entry stopped, then you're either going to be jump ball break even, or you're going to win some money. So your losses are only at trade entry. You don't lose once the trade goes into profit because you protect that profit, right? So the issue of losses is a complete result of the trade entry. So that's the problem. That's where you're getting into it. So one of the issues that I've found in this, it's, you know, you say timing. Well, you know, what is it? What do you mean by that? Well, there's a lot of shades of it, but I think one of the most obvious, this is what I want to talk about in this video, is when you actually take the trade from the time that you do your entry analysis. And I caution you that this is a concern for the day trader and not really that of the long-term trader. If you're a long-term trader, you're looking to make 200-300 pips, your take point could be, you know, 20 or 30 pips away from where you are, because you're waiting for these daily structures or 4-hour structures in order to firm themselves up. In day trading, we don't have that luxury. Now, there are other issues that can go wrong in the long-term trading, and I've gone over that in other videos. I'm sure you're aware of that. Those are the two schools of thought, is that, you know, a great majority of the traders feel that they're far safer, right, in the long-term trading, and there are folks like me that are much more secure in the short-term basis, and being a day trader. Look, I came out of 40 years of real estate. That's a long-term trade, and I felt very safe because I stayed in some properties for 20 and 30 years, allowing the compounding to take place with a great probability that that would happen. Although, as I've admitted in many of my videos, I've lost $1 million net worth twice in my life, was able to get that back, but I never lost my base, and so I still had the base in order to build back, because my loan-to-value ratios and leverage and all that stuff were good, because I know how to play that game. That's the long game. in coming into currency trading, those things flip around. That you're risking what you're risking and what you're looking for as a profit target, and the timing that goes into that is totally different than in real estate. Now, realizing that and having 40 years of experience and emotional success in dealing with that is two other things, and so you really have to separate the two. So in any event, an issue here is I'm a day trader because I have more, I don't feel, I have more control over my risk as a day trader than I do as a long-term trader. And when I lose, it's because I do something stupid. If I'm a long-term trader and I lose, it's because I don't understand the mechanics of what's involved. And I don't get the rationale that the longer term traders have. I mean, if you want to go into stocks, you want to go into, I suppose you could even hold a futures contract for a while and roll those over. I'm not real sure that from a retail trader standpoint that the long term trade is the best trade for you to make. Look, I just got out of a long-term trade the other day. I made $1,500. It wasn't really a long-term trade. It was a few days. And I made $1,500. For the period of time that I was in, I think it was 6 or 8 days, something like that. You divide the $1,500 by 6. Well, if you divide it by 5 days, you get $300 a day. And with the size bank that I have, I can do that on a daily basis. So the issue was that trade could have gone. I was fortunate. I got out, and I made the $1,500. So that with the $300 normal day that I might have if I'm trading, it's kind of a balance out. Although the 5 or 8 or 10 day trading hold period that I have might encompass 2 weekends or something where you're losing a couple of days in there, but you still have to add them into your per day basis, right? Because you don't have any control over what's happening. You have to hold it. And so you're reducing your daily amount as a function of the amount of money that you have at risk. And so you look at what you can do on a daily basis and compare that with that same dollar amount that you have made over a longer period of time divided by the holding period. And most of the time that's not going to balance out, because as long-term traders we get impatient and we say, oh, we're going to hold this thing for 3 weeks or 4 weeks, and I've got $1,000 here, I got $2,000 of profit, boom, I'm going to take that $2,000 of profit. Well, yeah, if you divide the $2,000 of profit by the 35 days that you held the trade, I mean, did you get paid for the risk and the time that you took? And so, again, we're back to considerations of the assumption that you had a good trade entry. The problem here is the timing of that trade entry. If you understand this at a day trade level, you're going to be much better prepared to map that up into the longer term time frames and be able to make that determination as to the amount of distance between the actual execution of the trade and when you're doing the analysis. You use the short-term information that I'm giving you here to map that into the longer term. But if you're a long-term trader, you're not going to be able to back out of that and come down into the short-term environment and be successful with it. I mean, I think if you're a really skilled trader, you might be able to do that. But if you're like most retail traders with a couple of years experience or a couple of months experience or something like that, I really think you have the skill to do that. You don't have the awareness of the market. My whole premise in teaching, I mean, I do stuff that I wouldn't recommend on my video channel, simply because I've been messing around with these markets, these currency markets, since 2007, and look, more from an academic standpoint. And then you can look at my other videos for my sad story of my whole career in the currencies. But what I've seen happen to my own trading is that I'll get up and I'll look at this trade morass or this chart clutter on the screen and try to determine if there's the potential for a trade. Is there enough reward if I took this trade? If I got into this trade, would there be enough reward for that? And you'd say, well, yeah, there is. So there's that and then you go through the other steps in your trade entry analysis. And you say, great, I'm going to take this trade. Well, I'm going to take this trade when? Very rarely do you want to do a market order to get in. I think that's almost an anticipatory, even though you've done your analysis, that's almost an anticipatory move. I think if you do a market order on a trade entry, I think you've taken all of your probabilistic advantage, your edge, and you've wiped that all out, and you're basically doing jump ball trade at that point. The advice is that you have to let the price come to you. You say, okay, I've got a good trade entry, I've got 20 or 30 pips, I'm expecting to get 10 or 15 of them, and so right now I identify that there's a good trade entry. Great, I don't do a market order. I got to set a limit order, a limit buy if you're going to go long. Well, how far out is that going to be? What's it going to take to prove that your analysis of the momentum of that price is correct? You've got to give that price some time to move and prove that your momentum analysis was correct and that it has that special juju pixie dust sauce stuff to make the price continue on to the profit target, right? And so you have to be very, very careful. If you're not going to do a limit order, how long do you have to wait for that price to prove itself before you execute from that limit order? And if you wait 10 pips for it to get in, you know as well as I do that the time that it takes that price to go 10 pips, which on a 5-minute chart could be 2 or 3 bars, because a 5-minute chart on the majors, and I'm dealing with a 5-period ATR on the 5-minute bar. So 10 pips could take 2 or 3 candles. The whole world can change in 2 or 3 candles. So while you're sitting there confident that your trade entry is correct and you're waiting for 3 candles to go by to hit your limit order, it hits the limit order and then it turns around and goes south and stops you. And particularly if you're carrying a short stop like I advocate, man, you're going to get hammered more times than not. And if you're setting a long stop, well, you waited a long time to get in, so why would you wait a long time for your stop limit? 20 pips. That's reasonable. You're shooting for 20 and you get a 20 pip stop. You got a good win-to-loss ratio, hopefully. Well, but how are you going to get a good win-to-loss ratio if that price goes down and you get stopped for 20? You get stopped out at 20 pips, and you can't let that thing. If you say, okay, I'm going to give this trade a 20 pip stop, you can't change that. You gotta let the price go. You can't go, oh, I'm getting nervous about it. I'm at 10 pips loss. I'm gonna get out. No. You can't do that because now you're changing the parameters of the game. So the complication that I need to add to your trade entry thought process is the pip differential between when you identify the trade entry as opposed to where you're going to put your order to get in. And I can't tell you what that distance should be, but I just caution you because it isn't something else, it's a secret. It's because it's all situation dependent. 2 pips might be fine. Maybe prices retracted a little bit and you say, well, okay, if it goes over the top of the bar, the previous bar, that's my signal. That's the trip point, the trigger. I don't know, I can't tell you that because it's situation dependent. And that's something that you do in conjunction with consulting or mentoring with somebody as you look over a situation, and you don't try to do that in real time. You have to do it in past time so that you can see where the thing got to, so that you're making decisions down here that you can see are going to affect it, and then you try to match up a pattern or a situation that's going to end up to be a success for you. But the whole thing boils down to timing that trade entry, and there's a whole other definition of timing trade entry than the one that I just gave. The one that I just gave, I don't see anybody talking about it. And so I think you need to be aware of that differential between when you identify the profit target and how much distance there's going to be between where you are and doing your trade entry analysis and where the actual point is that you have your limit order to get into that trade. Be very, very cautious and very, very aware of what you're doing when you do that, particularly if you need to set that take point far, and I'll put that in quotes, air quotes, as to the likelihood that price may just hit that entry point. A new situation has changed. You wouldn't, if you did the trade entry analysis at that point, at that time where the price hit the take point, you might say, oh, I don't want to take that price right now. It's not demonstrating the momentum that I really should have it. But you've already set your mind and you've set that limit point, and now you've waited that 4 or 5 or 8 pips for the price to get to you. You got to really be careful with that. Now, the solution to all that is that you fail so many times that you kind of develop a intuitive feeling for what that distance should be based on the situations that are presenting themselves at that time, and you become comfortable. You say, well, I could set that out 10 pips away from where I'm at, or I could, maybe for my take 3 pips out is too much. I don't know what that is, but you develop a comfortability not only within yourself and your trading ability, but your knowledge of the movement of the currency pair that you're dealing with. Because I only deal with one currency pair, it's like a kid. I understand when it squeaks and what's going on. I've got a trade on right now. I had an $850 day the other day, and closed everything out, and then got to the end of the day. Oh, here's a trade entry opportunity. I'll set some limit orders, and if price gets there, yeah, I'm going to go in. And I just let it sit. That's one of those things where that entry point was quite a bit far away. It was like 20 pips away from where I did my analysis. And so later that evening, one of those orders kicked off, and I said, great, I'm in good shape. Went to bed, got up in the morning, the second block of orders went in, and so I'm sitting with my full position, and the price had flipped around, and it went, I don't know, $2,000 or $3,000 against me. But I'm not worried about that because I'm familiar with the actions of that particular currency pair and the economics going on, the balance of economics between those two countries. I'm not going to worry about it because my win-to-loss ratio is so good that, and I've made enough money that even if this thing goes off $3,000 or $4,000, I'm still in great shape from a percentage standpoint of overall gain on bank. I'm doing the long play on all my trading, not just worrying about each individual one, because I understand the probabilities and statistics, and I understand the pair that I'm working with. That's not something I would suggest to you as a couple of year trader. I think that you need to be really, really, really fearful once that trade entry hits, and you're in that trade, you go from being greedy for how you stage in your lots and all, and get all that set, to becoming very, very fearful of that price, not, once it's triggered, not having that momentum in order to get to that profit target. And you need to make those decisions in real time. You're not making real-time decisions by doing a carry trade, right? So your mental process has to change. But to be safe, and the majority of what I do is I sit there, I look at my trade. That take point is not very far from where my analysis is. As soon as it tricks in, I'm hyper alert and very fearful, and I'm watching that thing, because if it starts to turn against me, I got the wrong timing. I didn't make the wrong decision. I got the wrong when. And that's that third characteristic of a trade that you really have to look at. What do you do? How do you do it? And when do you do it? And that's what I'm talking about with this timing of a trade entry. The specific aspect of the timing of a trade entry is the pip differential between when you do your analysis versus where you feel you need to put that limit order for that trade to take off. Peter Rose, Longwood Currency Trading. Have a great day, and have a great trading day, and I hope your day is a little bit more colorful than what I've got right now.